I'm live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Liquor Property of the Week. I am your host, Pablo Gonzalez. With me, as always, today virtually, the man that I like to call GC, because he's got genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, GC.
Hello, everyone. Great to be with you.
I really like that cadence. And with us today is, as always, in the chat, always doing what she can to add some value. We call her the Magnificent Madison, the Magnificent. Welcome, Madison Lipson.
Hello, everybody.
We love having our audience that hangs out with us in your ear, listening to a podcast. We love you if you're hanging out with us on Facebook. We love you if you're hanging out on YouTube, but we would love you if you nyais.com, register for the show, put it on your calendar. I promise you're going to have a really, really good time when you show up, be a part of the roll call, graduate to getting a nickname, maybe one day be a star of the show, and maybe even meet us IRL in our meetups today. Y'all ready for the roll call?
Game on.
Absolutely.
Let's go. Roll call. We got John Hannon. Good afternoon, all. We got Lee Bishop saying hello, Greg, Pablo, and Madison. He's the MVP of the Not Your Average Investor Show community. And you can tell because he beat Madison to the welcome to the Not Your Average Investor Show in the chat. Who else we got? We got Camille Jameson from Jameson Financial. She is founder and CEO at Newark, New Jersey. Good to have you back, Camille. We got Bill Shields saying, yo, amigos. All right. We got some Spanglish today, Bill Shields. I respect that. We got Victor Scarpula. He's back. Says, hi, everyone. Nice to see you. Drew Barnhill, the master of the Not Your Average Investor Show community and immediate past star of the show. Barnhill, good to have you back. Leo Faraganan, good morning. All the way from the Bay Area. I got it. It's nailed.
Love
Faraganan. All right. It's just a Muppet song. I got it. You changed my life with it, Jen Filson. Thank you so much. Noah Rondari, he's back. Nickname TBD. Hello, everyone. Greetings to you all. We got the other Greg, Gregory Stone from New Jersey is back with us. Thank Greg. Good to have you. Who else we got here in the chat checking in? We got Jen Filson, previously mentioned, the fairy godmother of the Not Your Average Investor Show community. Greetings from Monterey, California. We got Ken and Carol Malee, the matriarch and patriarch of the first family of the Not Your Average Investor Show. Good to be back. We got Louis Hudnall from In the Morning in Milpitas, California, my favorite place to pronounce. What else we got? And all right, we got Raj Bantu. All right. So now, without further ado, the segment that I wait all week for, Madison shares good news.
Oh, yes. We got some real good news this week. I think this is probably my favorite good news to share, if I'm being honest with you.
Ooh, all right.
Yeah.
High billing.
Get your hopes up because here we go. All right. So once a month, everybody knows we do a client tour last Friday of every month. It just so happens to be that Friday. So the JWB team has an awesome opportunity to get to hang out with two awesome families. Our very own Gary and Rosalind Riley are coming.
Rosalind Riley.
Oh, yeah. We love the Rileys.
We are so happy that she's here. Returning Rosalind Riley.
The regular Rosalind Riley.
She's going to show up to JWB office tomorrow. So the Rileys have been clients since 2019. They own 4 properties. Their 4th is actually set to close this month. So super cool, super exciting. And then we have Carol McCara and her family coming. So they have been clients since 2018 and they own 1 property, but I'm sure that'll go up sooner or later. So super excited to get to meet and hang out and talk to these families. So
it's amazing. I think the key word there is family because, somewhere along the lines, this client visit and client tour that we have been offering for years, I just remember starting to meet so many more than just clients of their family, and husbands, wives, brothers, sisters, kids routinely now come on this client tour because it's worth so much more than just going to see this property, right? It's about coming and meeting this team, and it's about coming and seeing what Jacksonville really is, even for those who live very far away. One of the most touching experiences has been when folks have brought their kids and wanted to expose their kids to what successful entrepreneurship looks like, and a team and a culture, whether you're going to be an entrepreneur or whether you are not going to be an entrepreneur, working in a culture that you can wake up every single day and be surrounded by like-minded people and accomplish some really great things. So
the McCara's 15-year-old son is coming with them. So
I didn't even know that.
Mhm.
I was literally just riffing. I didn't even know that. Wow. Perfect. Well, we're super, super excited to see both of those families. And you're right, Madison. That is the best news.
It's my favorite news. So
That's what we call good news. All right, let's go on with the call. So, see, before we go into the property, I just got it here. We got beep, 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 beep. We got breaking news. GC, what do you got? Breaking news.
Got some breaking news for you. So there is a project that we talked a lot about here for those who have been following the economics of Jacksonville. We talked about it for years and years and years, especially when the Panama Canal project was going on and they were widening and deepening the Panama Canal to allow for larger ships to come over. We said, well, listen, this is going to be a big boon for the economy of Jacksonville and for other ports along the eastern seaboard as those bigger ships come through the Panama Canal. And all of that cargo now can come to the East Coast and come to Jacksonville's port. And so I don't know when that project finished. I'm going to guess probably 5 years ago or so, maybe longer. You guys can look it up, but it is a major, major project in the shipping lines and economics of those ports. So that was a big deal a long time ago. The next thing for Jacksonville to do was to prepare our port for these larger ships to be able to come back or be able to come by. They're called post-Panamax ships. They are larger ships and they require a deeper channel to go through. So Jacksonville for the last 4 years has endeavored onto this project, a major project for Jacksport and for our overall economy. And guess what? Last week, they moved the last bit of dredged waterway, sand, dirt, everything they're dredging up in our canal, in our channel. They did the last bit of that dredging and commemorated it as we completed our 11-mile shipping channel project here at Jacksport. This is a major deal. We dredged our waterway from 40 feet to a depth of 47 feet. It allows now for those post-Panamax ships to come through. And here's the craziest thing. I don't know the last time that I heard a project that was largely funded by the government that came in under budget and ahead of schedule. That's what I said. Under budget and ahead of schedule. That is very, very impressive. Big shout out to Eric Green, who's the CEO of Jacksport and who we would love to get on the Not Your Average Investor show at some point here pretty soon. Yeah, so this project is one of the biggest projects in Jacksport's history in Jacksonville economics and the economy here. That project alone, this project we just finished, will create or protect 15,000 jobs here in our local economy. And it's not the only project here. Now that we've completed the shipping channel, we already have funded and are planning and are doing $100 million more worth of investments in the infrastructure in Jacksport so that we can handle not just one of these larger ships to come in, but 2 of these larger ships simultaneously. That's going to be a $100 million investment, and that's scheduled to be completed in, I believe, the spring of 2023. So that means probably like tomorrow, according to Eric's schedule here. But yeah, just a very big deal. If you want major reasons why you should be investing in a market, you want to look at major drivers of the economy. A port like we have at Jacksport is one of those major reasons to love Jacksonville. We're the largest container port in the state of Florida. We're the 14th largest container port in the entire country. We're a big deal, and that's even before these larger ships can now come through. So a big win for our investors who are buying properties and holding on to properties now, because these jobs are going to benefit both rent prices and home price growth in the future. And for those who are thinking about now, this is a big reason why this is going to be a sound investment for you over the next 10 or 20 years.
Love that, man. I remember I was in Miami when they finished, right? Like they were beating their chest about the fact that they were the first ones to make Panamax a friendly port and the advantages that creates and the boon that creates for the economy. And, now that Jacksonville is coming online and that advantage that it creates, right? Like the idea that we are anything that goes to Puerto Rico comes out of Jacksonville, right? And like that trading partner and that like access to the Caribbean and all these different things. And kind of how we talked in a past show of how commercial real estate is getting impacted by the Amazon world, right? Like this idea that all these like warehouses and industrial spaces are buoying the economy because of this. Like I'm sure that the externalities of this are obvious, and we don't even know yet just how much it's going to affect the economy. Very
Absolutely. And Miami does have a large port, and that's wonderful. But when you combine a large port that can handle these post-Panamax ships that we're talking about here in Jacksonville, and you actually have land around Jacksonville to develop for industrial, you don't have that in Miami, right, Pablo?
No, you don't. You don't. And you also, you land in Miami and you got to drive 6 hours before you get to any other like major city, right? So it's a big deal.
Yes, it is.
Love that. All right, GC. So let's move on to here. We got another breaking news, GC. Here's some breaking news for you.
Oh, yeah?
Memorial Day is coming up this weekend. We love our veterans. Thank you very much for your service. But it's also the first anniversary of when you were in Pebble Beach, had breakfast with Jen and Renee, and it was then the birthplace of the IRL meetup.
Man,
and
so
we're coming up
cool.
on the 1 year anniversary of us really starting to take the IRL meetups seriously. And I just think it's really awesome to celebrate this idea that this week IRL is going to Pittsburgh, the hometown of GC. And we've already hosted we've hosted multiple events in Northern California. We're already gearing up for a second event up in Seattle. We've had an event in Denver. We've had an event now coming up in Pittsburgh. And this is going to be our second super de-duper meetup in Jacksonville coming up in June. So I thought that was awesome that Jen brought it up in the Q&A, and I wanted to celebrate that, man.
I think that's amazing. I had forgotten that it was Memorial Day last year when we kicked this thing off, but I still remember going out to breakfast with Jen and her husband Renee, and we sat down, and it wasn't a like, hey, how can we strategize how to like start to do all these events? It was like, hey, I love you. It's awesome to hang out with you. Wouldn't it be cool if we could hang out more together and maybe invite a few more of our friends out together, and that's where it transpired. And no better person than the fairy godmother of the Not Your Average Investor community to lead this past year for our IRL event. So we're all very, very thankful for Jen and for Renee for spearheading this. And it's just going to be a lot of fun. And, if you can't make it to the Pittsburgh one, which is happening this weekend, then we would love to see you at the super duper one here in Jacksonville, June 24th. We're already making arrangements here. And so if you'd like to do that, reach out to Jen and we'll see you here in Jacksonville.
June 24th. It is the day of super de-duperness. All right, GC, I think it is right now time that we magically whisk ourselves away to 11142 Pine Street, Jacksonville, Florida, 32218. It's got a purchase price of $235,000. It is a 3-bedroom, 2-bathroom home, 2-car garage, has a lease for 2 years at $1,475. And what we always like to talk about, what we're actually buying here as investors, this estimated conventional total monthly cash flow of $36 and an estimated conventional financing total IRR of 12.39%. GC, before we dive further into this property, what do you love about this property?
I thought you'd never ask. Well, here's what I love about this property. Number one, look at it, man. It's nice. It's brand new construction. I try to show a healthy balance of new construction, brand new construction homes and renovated homes. And so we have been doing a couple of renovations that were amazing investments the last couple of weeks. It's time to shine a spotlight on our brand new construction homes as well. We still do have a lot of those. As you all know, I love them both, but there's different reasons that I love brand new construction versus different reasons why I love renovations. And I have both in my portfolio. So if you'll allow me just to brag a little bit on new construction, I'm going to do that right here, but don't get that twisted. Don't think that I don't love renovations, but new construction, right? We're going to talk about one of the reasons that new construction is able to be cash flow positive. It's able to produce a positive return on investment on a monthly basis from the rents and the cash flows is because you have low insurance costs when it comes to new construction properties. That's really wonderful, right? Low insurance costs. Right now, the insurance on this one comes in at about $400 for the premium each year. Well, that's really great. For a renovated home, it's going to be more than that. And so on the new construction side, this is one of the hidden secrets as to how we're able to still get new construction homes still to be cash flow positive. It's because you've got low property insurance costs. So certainly want to highlight that. If I'm showing the opposite side of it on the reno side, you got higher insurance costs, but you make it up because you have lower purchase prices and your rents compared to your purchase prices are higher on the reno side. But if we can get low insurance costs and it's brand new construction, we love that. The other thing is simply this one is available now. So if you are somebody who has been sitting on the sidelines, maybe you listen to the Jacksonville market update, a couple of weeks ago when I came really strong and I said, hey, listen, this is the time. If you've been planning on buying a property in the next year and you have money in the stock market and you don't want to lose that, you want to preserve that capital, what better time than right now to take that money that is in the stock market, take it out before you lose it, before the market drops more, and put it into this asset class that you probably wanted to be in anyways, which is rental property investing. Since then, the market, since I came strong with that, the S&P value has gone down, right? And the average median home sales price in Jacksonville has gone up, which is what we expect to continue to happen through the rest of this year. So the other thing is, though, if you're listening to me and you're saying, hey, listen, that makes sense. I should take money out of the stock market. I probably should have done it a long time ago, but now it really makes sense to put it into rental property investing. The next problem you're going to run into is there available inventory? Most places in the country just simply do not have enough supply. This property is available. We do have other properties right now that are available for JWB. We've had a great run of completing our new construction projects recently, which is wonderful. That's how we can stay ahead of a waiting list from time to time. Well, that's what we have right here. So it's available. You're allowed to lock in your interest rates before they are expected to go up. Just reading articles about the Fed's minutes, which is when they meet and they write down what they talked about. Without a doubt, they came strong and they said, we're going to have a lot of interest rate increases through the rest of this year. And they said the interest rate increases are typically going to be double of what they've done in the past. So interest rates are going up, and that will affect your positive cash flow if you make that same decision later on. So you can buy this property, you can lock in an interest rate, and you get to buy it before expected home prices, increase as well, which is a great way to start out in the investment. So available, brand new construction, low property insurance costs. That's why I love this one on Pine Street.
Yeah, it's interesting to watch all this stuff kind of come to fruition, right? Like this, a $235,000 home a year ago would have been like a 4-bedroom home. It would have been, this is a smaller home than what we're used to seeing at 235 over the time on the show, right? This like 3-bedroom, 2-bathroom, which is a sign of rising property prices and stuff like that. Is there something to consider between like 3-bedroom, 2-bathroom homes, or like 4-bedroom homes, anything like that you see? Is there like a sweet spot size of the JWB inventory?
No, I love them all. I have 2-bedroom homes in my portfolio. I have 3-bedroom homes in my portfolio. I have 4-bedroom homes in my portfolio, right? What will happen for a 2-bedroom home, a 3-bedroom home, a 4-bedroom home is you just look at what the purchase price is and you look at what the rents are and you look at all the other variables. And that's why we make it easy and calculate what this return on investment calculation does, right? It's a way to standardize and equalize across those different variables. And so if it's a 3-bedroom home and it's this is a 12% return on investment estimated. Well, if that was a 4-bedroom home or that was a 2-bedroom home, I'd be fired up for it, right? If it was an 8% return, and it was a 4-bedroom home or a 3-bedroom home or a 2-bedroom home, I'd say, no, that's not good enough for me to buy right now because the market can deliver a 12%-ish return on investment. So yeah, I'm agnostic when it comes to 2, 3s, and 4s. It's just got to deliver, and it's easy to rent out any of those.
So let's talk about it. Before we dive into some questions, let's talk about the returns then, right? So this $36 total monthly cash flow versus this 12.39%. Can you explain to me what this $36 total monthly cash flow represents, GC?
Yeah. On a monthly basis, is this asset paying for itself and then some? Is it putting some money in your pocket or is it not? That's the first rule of rental property investing. We want to be investing in assets that pay for themselves every single month. If they can put a little bit of positive cash flow in your bank account at the end of every month, that's great. But the key is that they are cash flow positive, and that's what that represents. And the reason is because this is your greatest form of risk mitigation, right? I was investing in 2006 and 2007. I bought 40 rental properties as a young lad who was just getting into real estate at that time. And I held on to those properties as the overall property values dropped 35% in the next 3, 4, 5 years. I held on to those properties, even though I didn't have the financial wherewithal to it's not like I had deep pockets at that time, right? The reason why I was able to hold on to those properties and I still own them today and they've done incredibly well over the long haul is because cash flow saved me. I knew enough that the first rule of investing in rental properties was to make sure that it paid for itself. So as the overall home prices went down, rent prices stayed consistent. Many people aren't aware of that. And rent prices are what affect your daily life, right? The net rental income affects your daily life a lot more than home prices do. And so, but you got to know that in advance. And that's why we point this out, that it needs to be cash flow positive. It's because that's risk mitigation, right? If it was negative, then what you're doing is you're speculating. You're hoping that home values go up. Right? That's not what this asset class is built on. It's built on a solid strategy of risk mitigation, as well as outsized upward possibilities, appreciation, right? Upside. Thank you. That's the word I was looking for. It's risk mitigation and upside. And the first point is risk mitigation. So that's what that $36 represents.
Entry to the dance, right? Like the idea that it's not a liability, that it's an asset because you're not having to pay for it every week, reduces the risk of things going upside down for you in hard times. I love it. And adds your ability to add more and more chips to the stack, which I love. Great, man. Well, about the IRR, talk to me about the ROI in parentheses, IRR. What does that mean to us?
We're going to keep it simple. We're going to call it return on investment. All of those things together, right? They are a form of seeing how hard your money is working for you. As an investor, you need to think of yourself as a financial engineer, and you are the asset manager, right? And your assets need to be delivering a certain return on investment for you so that you can reach your financial goals in 5 years, 10 years, 20 years, whatever your goals are, right? Well, the way that you take accountability is you make sure that you make wise decisions that have the ability to hit that return on investment. And then you make sure that every single year they're performing for you. They're performing at that clip, right? If they're not, you ask why and you figure out, maybe you make some changes along the way, right? Well, so this 12% return on investment is simply saying that my money, if you buy this property, if your money is going to work for you at a return of 12% each and every year that you own it. And this is built off of a 10-year buy and hold schedule, right? So if you're buying and holding for a full market cycle, 10 to 20 years, this asset should perform at roughly a 12% return on investment year in and year out. And that's what the market is bearing right now for passive income in Jacksonville. And then compare that to historically what you've been able to get in the stock market. And there hasn't been one time when I looked over the past 20 years of a buy and hold strategy in the stock market that's delivered as high of returns as what you're seeing here on these investment properties.
Love that. So I want to get into questions, but real quick, if you've been watching the show for a while, we used to not include appreciation rate. Like appreciation rate used to be at 0, and then we'd pop it in and it would jump to these like big numbers. Why is it that now that it's IRR and includes appreciation, before it used to pop up to like a 18 to 24% number, and now it's only like a 12.39% number? GC, can you explain that?
I love that we're getting into that, because that's a great question. These are the same properties, but what we're showing here is by including what's called an internal rate of return, which is the standard approach to evaluating a project that spans multiple years. So when you're buying and holding rental properties, it's a 10-year or a 20-year hold is your mentality. You need to do something called an internal rate of return to look at and evaluate your returns on investment, taking into account how much time it took to get there. So that's what we're doing. If we were to only look at the return on investment on a 1-year hold, this same property would produce 18 or 20% or 22%. Like that number I could easily put that number up there at 20% or 22%. And if you're looking at other evaluations across other turnkey providers in this space, almost every single one of them does it that exact way. They are assuming that you're putting your money out today and you get your money back next year. I'm here to tell you that doesn't work in rental property investing. If you do that, typically you lose, because there's so many costs involved with selling the property later on for a higher purchase price. So it just doesn't work that way in rental properties. But Bob, I'm really glad that you kind of like went down that segment, because I think this is a topic that we're going to dive more into in the coming weeks. I'm going to show you what the difference in terms of an evaluation, what the difference between an ROI, between an IRR, and I'm also going to show you the tricks that others pull to inflate their return on investment compared to what this 12% number is. So this is the standard approach, whether you're buying a business or whether you're investing in a huge development project, or you're buying a share of stock, or you're buying a rental property. This is this common scorecard approach where you can compare apples to apples. Unfortunately, other people get enamored by really large return numbers, but if you held them to the same standard, many times it'd be a lot lower than the same 12% figure.
Love that. And I love that you teased kind of an upcoming episode. You said in the coming weeks. It's Tuesday that we're going over this.
Tuesday?
Right? Like,
Yes.
I believe so. Yeah. I know you've been chomping at the bit for having this educational session. And I want to put it out there to our community. You know, normally on Tuesdays, we've been having a lot more interviews and we go diving into a lot more asset classes. We think that right now, the market is so topsy-turvy. Things are so scary that we're going to take the philosophy that we took kind of when COVID started breaking out. And it was really just showing up, less of an agenda, much more of just like what's happening right now. What is Gregg seeing? What does he think that would be important for you to understand? And, you know, diving into it. It's going to be a little bit more thought leadership. It's going to be a little bit more us showing up and having a conversation and hoping that you join in on the conversation. This Tuesday is going to be the first experiment with that. And we really believe, you know, for the last like 4 weeks of runs, Gregg doesn't shut up about IRR. So we gotta put it on the schedule because it really is something that I'm having a hard time understanding. So we want to make sure that everybody understands this so that you become an IRR ninja and be able to, you know, go in with your eyes wide open for any kind of deals that you are investing in, whether it is rental properties or the stock market or syndication or whatever, you know, whatever else you're looking at. So, all right, GC, you want to hop into a couple questions here?
Let's do it, man.
First of all, what this 32218, what neighborhood is this? Do you know?
This is the north side.
This is the north side. All right. So typical JWB neighborhood.
Absolutely. Hundreds of other JWB properties right in that area. It's our bread and butter.
Per the usual. All right, cool. So that being said, I'm going to start with Lee Bishop since he's the MVP of the community. He's got a question. He says, I have purchased $160,000 for a brand new 3-bedroom, 2-bathroom, 1,209 square foot home in late 2019. I love to see the valuation of the homes now at $235K. And this is what I'm seeing in the valuation of my homes. My question is about the price being $235K. And I am curious, which of the 4 core neighborhoods are having better home price appreciation statistics?
Interesting that you asked that question, Lee, because I am actually doing some research to see what the home price appreciation has been for our core neighborhoods. It wasn't really to compare between those core neighborhoods, but I wanted to compare to the overall Jacksonville home price appreciation rate. So by going down that path, I'm going to get the same information. So just hold on a little bit there. I'm going to have some good data that we can share as far as appreciation rates. But was there another question that I forgot? I want to make sure I answered it all.
No, he was asking what are the neighborhoods, which one of the neighborhoods are having higher home price appreciation?
Yeah. So I'll have some of that information there as well. You know, the punchline though, I was just talking about this. I was doing some training with some of my team and we were talking about, you know, why does JWB love all 4 of our neighborhoods the same, right? Because a lot of times we'll get asked the question, well, listen, should I invest in the north side because I'm going to see more home price appreciation, or the west side or south side or Arlington? And what I believe and what we believe is that they're all 4 the same. And our job is to produce the best risk-adjusted return on investment for you over the next 10 or 20 years that you're going to be holding onto this property. And if I saw data in the past that would lead me to believe, or if I knew information today that was going to lead me to believe that you would have a much higher return on investment investing in the north side or west side or south side or Arlington, our 4 key neighborhoods, we would absolutely share that with you. But there's a reason that if you look at my own portfolio of over 300 rental properties, it is a healthy combination of all 4 of those neighborhoods. And the reason is because when you are thinking about how to deliver a return on investment over a 10 or a 20-year period of time, right? You look at, well, what can I control, right? Largely the controllables are on the passive income side. Okay. So you've got rents, right? You got collection of rent, you got maintenance costs, vacancy costs, right? The type of qualifications of the residents, right? All of the things that we do on the property management side to deliver, the passive income is, that's kind of one half of the equation. You can throw in your tax savings and your principal pay down. All of those are standardized, right? It's the same for those demographics in those 4 neighborhoods. We love investing in workforce housing and below middle income housing. And all 4 of those neighborhoods deliver roughly the same return on investment for the passive income side, right? This property that I'm putting in front of you here on Pine Street with roughly a 12% return, right? If you're interested in this one, you're probably going to be interested in the other properties we have available right now, because minus the zip code, which may change, it's the same thing with roughly a 12% return. And it's the same team, and it's the same construction, and everything's standardized. So there's no reason to value one neighborhood over another for the passive income side. Then let's go to the home price appreciation side. People think, well, maybe if I can just get in front of a major project that's happening right next to my rental property, I'm going to see outsized home price appreciation. I'm going to have a better return on my investment. We are talking about buying and holding over a 10 to 20 year cycle. The amount of variables that go into buying and holding over a 10 or 20 year cycle are enormous, right? How many of us would have thought that 20 years ago, we would have commercialized space travel, that we would be putting people, into space, that millionaires and billionaires would be paying to put people into space, and that NASA wouldn't be leading our space travel anymore. I didn't see that coming. I didn't know that. So if you want a reason to think that home price appreciation on the West Side is going to be a lot more than in other places, you could run with the fact that we have the longest horizontal launch runway that is going to be putting satellites for commercial purposes into the atmosphere, and Jacksonville spaceport, which we highlighted in one of our shows with the CEO of Jacksonville Aviation Authority. He was on our show and we was talking about this. Well, that's really close to your neighborhoods on the West Side there. If I really wanted to pitch you that that's going to be the area that's going to grow the most, I could totally go down that path. And, I don't do that. Why don't I do that? Well, listen, I could also talk about how in the South Side, there's the St. John's Town Center, which is the largest outdoor lifestyles mall tourist attraction around, and that's projected to grow more. Or that UNF, which is University of North Florida, is growing by leaps and bounds, and we expect that to totally increase population and raise home prices. Or the fact that that's closer to the beach. I could totally go down that path and make it seem like this was going to be outsized growth for South Side. Or we could talk about which is really close to the port of Jacksonville, Jacksport, and also has, Jacksonville University. I could pitch that and say, well, geez, I could also talk about how that's the birthplace of build to rent, and JWB has had a large influence there. And I could make that sound like that was going to be outsized growth. Or on the North Side, I could do the same thing. I could talk about the Amazon effect and how Amazon is propping up warehouses and distribution facilities at an alarming rate. Not alarming, that's probably the word, at a very fast rate. And that is serving our residents there in the North Side. And if you think that Amazon's going places, you could say that the North Side is going to grow faster. Or you could talk about the Jacksport effect, which is largely serving the North Side as well. So my point here is that when you're talking about 10 or 20 years, all of these reasons that people want you to think that are going to have outsized growth and higher property appreciation really lack something. They lack data. It is what people are it's cool to talk about. It makes people feel good. But my job is to deliver the best return on investment for you. And I look to data, and I'm conservative. And so I don't know which of these things are going to work better in your favor for home price appreciation in any of these markets. I don't think it's a worthwhile exercise to even go down that path with you. The worthwhile exercise is buy and invest in a growth market with the best team, which you have the entrance to the dance be your passive income, which is what you have in our 4 key neighborhoods. And your upside, the data that I have shows what Jacksonville has grown at over the past 40 years on average. And that's what you should expect. And anything more than that, because Spaceport takes off, or because Amazon has another 100 distribution facilities, or Jacksport does another amazing project and doubles the rental demand in Arlington and the North Side or, UNF and St. John's Town Center and all the wonderful things we have in Southside take off, that's just upside, right? You invest with the right team, one who's vertically integrated like JWB, we're going to get you there to that average home price appreciation growth. That's all this is based off of. And if you invest with the right team and you have somebody who's so vertically integrated, chances are that our neighborhoods are probably going to perform a little bit better than the average here for Jacksonville home price growth. So went on a little bit of a tangent there, but that's the reality. I don't fall in love with one neighborhood over another because there's no data and there's way too many variables to say, listen, this is going to be a better neighborhood than another for home price appreciation over 10 or 20 years.
GC, we haven't had a good old fashioned GC rant like that in a while, man. I feel like we've had so many guests and so many things that like you've been getting into this and I got interrupted. That was awesome, man.
Sweet.
That was cool. I appreciate that. Joanna, let's cut that one out and send it. I love it. All right, cool, man. So Camille Jameson, CEO and founder of Jameson Financials, is asking, will there be a chance to purchase shares in this property through a Series LLC?
Will there be a chance to purchase shares in this property through a Series LLC? At this time, no. I'm really curious how that works though. So
the fractionalization of like purchasing single family homes kind of thing.
Yeah, I'm really curious about it. So
Okay.
Starting to learn about it, but no, that is not in the works right now. That is not something to wait for. That is the farthest thing. That's a random thought in Gregg's mind right now. So if you want to buy assets, direct ownership and purchasing the entire asset is the way to do it at JWB.
See a little twinkle in your eye, kind of like if maybe this is one of those like R&D projects for JWB that you're so famous for. I don't know.
I mean, it just goes in line. Like I remember a comment from Hervé not too long ago, and he's just like, we were talking about what an opportunity it is to teach people about investing in rental properties, especially when they're young, about how to build a diversified portfolio. Like I don't believe a diversified portfolio means stocks, bonds, mutual funds. Like there is a need, there's an asset out there that people need to own that is much more consistent and helps them and their financial wherewithal to steady the storm and also give them upside. That asset that people already have a huge interest in is real estate, but it's not a space that a lot of young people can get into because your down payments are larger, right? You can't just put $100 into something in real estate and buy a piece of a property, whereas you can buy $100 of a share of stock. And so if you could overcome this access and have it be more democratized, it is a mission that I can really rally around. I think we have done that as a business in every way, shape, and form around there, making it easy for people to invest in rental properties. And there's a lot of new technology and new things that are happening right now that are democratizing a lot of different spaces. So I look forward to the day when real estate can also join that group. And so I'm definitely exploring any ways to make that happen, to decrease to decrease down payments, but it's not on the horizon.
All right, cool, man. Love that. Well, speaking of the R&D department over at JWB, John Henning's got a question. Can Gregg talk a little about the JWB proposed 175 unit in the Cathedral District?
Yeah, I could talk a little bit about it. This is another big investment in downtown Jacksonville. So what John's talking about is we recently received approval for 175 units that we'll be building. It's a townhome community in downtown Jacksonville. This is another JWB project that we use our own money on and we hold because we believe in downtown. And there's a real missing opportunity for workforce housing in Jacksonville and even market rate housing, right? Right now there's workforce housing, which is typically your affordable housing, right? There's a missing middle there. And then as rents rise in Jacksonville, there's just not a lot of rent or places to rent townhomes in the downtown community. So it's one that we are moving forward on. We're excited about it. It just, reinforces our commitment to downtown Jacksonville. It's not something that we are selling. It's because, we believe in it. It is an investment that the numbers don't pay off in the short run, like all of our downtown investments, right? We earn a very low return on investment in our downtown investments. It's not why we do it. We do it to be a part of the growth of downtown, to serve the community. We expect to earn a large return on investment many years down the road. And so and that's not the only one you're going to be hearing about. There's a lot more than that coming down the pipe.
So 175 townhome rental units that you will manage and rent out to folks, and it's not open to outside investment. because you are betting long-term in this idea that median income rates are gonna rise as long as there is a supply of workforce to be able to like maintain these companies that are moving here, right?
Yeah, we expect big growth for population in downtown Jacksonville, and population in downtown Jacksonville is going to need a place to live. They're going to need a place to park. They're going to need a place to go out to dinner. And so all of the investment that you're seeing in Jacksonville's downtown by JWB are investing in buildings that will become wonderful amenities for people to eat or to have high-end weddings and things of that nature. You're also seeing JWB own parking garages because people need a place to park. And this is an example of people needing a place to live too. You know, we have roughly 6,500 residents living downtown now. That's up from about 3,500 from a few years ago. We expect within the next year or two to be at 10,000 residents living downtown. And so we and a lot of other developers are seeing that, and they're starting to get out in front of it and starting to build those units so that we can take care of that demand when it's there.
Interesting, man. I think it's one of the more fascinating stories about you and your team is this idea that the owners of JWB, the partners at JWB are all in your late 30s. You got kids that are under 10 years old, and you have investors that have bought assets all around downtown, including your own assets downtown, which allow you to look at these long-term plays and play, you know, have this long-term outlook to get in early on things that are really going to move the needle for everybody else around you, including yourselves, including your kids, and also make a really, really big push forward for the city that normally public investment wouldn't be able to do, and private investment, it's just too long-term of a window for. Like I find that so fascinating that the four of you can literally say, I want my kids to graduate college and move here, and you can actually do something about it, and you're doing something about it. It's insane.
It's like the coolest thing about our business is that we're big enough to have an impact, but we're small enough to make decisions the way that we want to be able to make decisions, right? And this is just a great example. I mean, it'd be hard to sell this to shareholders or a board of directors who are looking for quarterly profits to go up. Like the projects that you're seeing in downtown going on right now, they are not contributing to the quarterly profits of JWB right now. And that's okay, right? You need people like that out there to move this forward, because everybody else looks at it and they say, well, that's not going to give us a short-term bump to profits. We're not going to do it. If everybody always feels like that, it's not going to get done. So we like this role of leading that charge. And it's one of the things I love the most about my job every single day. You can make an impact.
Love it. Love it. Love it. All right. So Leo Fraganen has a question is, how is the rental market in Jacksonville right now? I closed on my second JWB property 2 weeks ago, 4-bedroom, 2 bathrooms, zip code 32218. It's been on 45 days now without any potential tenant. What is the next step to marketing the property?
Leo, great to hear from you, buddy. And congratulations on that property. You know, I think a little bit of perspective is healthy, right? Where we have been for the last, year to 2 years on renting properties has been the best, greatest opportunity when it comes to supply and demand. There's just not a lot of houses out there to rent. And when you have supply, your homes get rented very quickly. Historically, it takes somewhere around 45 days, 60 days maybe, to rent a property. That's just historically. And we've been able to perform for all of our clients with those same historical numbers. So at the end of the day, I am not concerned at all about our ability to deliver on your return on investment. I want to recognize the fact that this time it's going to take a little bit longer to rent your home out than it probably did a year ago or 2 years ago, because that's just like what was going on a year ago or 2 years ago when I was sharing those numbers with you guys. I was like, don't hold me accountable to this because it's not real. We're not always going to rent out homes in 15 days on average. This is more real. This is really what it's like to be an owner of rental properties, is to expect roughly 45 days, maybe 60 days to turn your home over. And so that's what all of your maintenance and vacancy expectations are built off of. They weren't built off of 15-day turns, turning your home over or renting them. So your returns are built for the long haul. The expectations are there. I'm sorry that's not rented as quickly as the last time, but for Leo and for everybody out there, like, this is real. This is what real life rental property investing is like. Expecting probably a 2-month turn when it's all said and done to move your home is normal. And that's the average. The other part of real life rental and investing is like the average means that half the time it's going to be better, half the time it's going to be worse, so it doesn't mean that there's a problem with the property if it goes 61 days or 65 days or 70 days. That happens as well, right? Leo, I want you to always, always hold us accountable to that return on investment calculation, right? That takes every bit of the equation into account. And our job is simply to do what we said we were going to do on that original evaluation and make sure that you have a wonderful customer experience. So keep holding us accountable to that. I love the question. I feel good about us delivering for you.
Awesome, man. Awesome. And, I think it's interesting that is the assumption that's on the sheets that we're putting up, right? Like this idea that is going to be 45 to 60. So if that's what's happening, those are still the numbers that are going to come through, I think is really, really important to recognize. Victor, I see that you're getting bad audio. Are you only getting bad audio when I speak, or is it when I speak and when Gregg speaks? Because I don't know, it could be my connection, it could be your connection, it could, it could be a couple different things. So double check that.
You're sounding better to me, just so you know. I mean, you always sound amazing, Pablo.
Thanks, Gregg.
You're sounding better right now.
Oh, appreciate it. Thanks so much. All right. So, GC, I got a question for you, man. We were talking about interest rates going up early on, right? So, first of all, I would love to know, is this property available?
This one is available. I checked right before.
Okay.
This one is available.
Okay, cool, man. So as you know, right, like I scooped up a property on the property of the week a couple of weeks ago, right? And I'm in the middle of on closing on that. And you're talking about interest rates going up twice as fast, and that kind of freaked me out. So can you tell me a little bit more on just the speed to getting this versus like affecting my returns and what you're seeing coming down the pike, and like, what do I need to do, or what would a prospective investor need to do if they want to grab this thing and they want to put it under contract real quick so they don't suffer that?
Yeah, the reason why you've seen me go stronger in availability being one of the best reasons to take action on a property is because of the phenomenon you're talking about, Pablo, is that if you buy this same property later on because there was a waiting list, or because it took time to build that home, or any of those reasons, that delays when you can actually put your home under contract, and that delays when you can actually lock in your interest rate. Because for an interest rate lock, generally, you need to close that loan 30, maybe 60 days after you lock that interest rate. So if we're talking about the property that you just purchased, Pablo, like the reason, like you are protected here, I don't know where you are in the loan process, but your property your interest rate can be locked, call it immediately, right? If we take a little bit of a step back here, the reason why JWB made the shift to no longer offering properties that were in the middle of construction, and we only started to offer them towards the end when they are within 45 days, is because we wanted to be able to give a realistic expectation of what your interest rate is and what it will be when you close on the home. That was one of the biggest considerations we gave. So Pablo, for your property, as long as you lock this thing right now, you're good. Right? There's no reason your property shouldn't close within 30 to 60 days. A lot of that's going to be driven by you, right? And getting your documentation in line and all that good stuff, right? That's really the biggest reson why clients might not close on time. So
which is why I put Martha in control of it.
We love that. We love that. We love that. So you should be good. And anybody else who's buying this property on Pine Street, or anybody else who's buying a property right now, we have catered this experience right now to avoid that situation where you're putting it under contract today, but by the time you close on it, the interest rate has jumped up a percentage point. I mean, we know what's coming down the pike. The Fed is signaling harder than they ever have that interest rates are going up, and that indirectly increases your long-term, your mortgage interest rates as well. So with that in mind, we said, listen, we need to do right by the client experience. We need to make sure that we only put properties in front of people when they can actually lock on the interest rate. So that's what you see here. And we expected 5 3/4 for your interest rate. So it's going to be somewhere right around there.
All right, man. Well, I appreciate that. GC, this was a fun call, man. I love the POTWs. I love the investor stories, but something about the POTWs is just me and you being able to rap and you being able to go on long rants and me not freaking out about it is a lot of fun. really had some great comments in the chat, great additions by Camille on like the fragmentation and the different things that we can talk about. Tons and tons of fun. I'm really looking forward to Tuesday. Like I know that you got the IRR breakdown and how you're going to teach that this Tuesday. I'm super, super pumped for that. We'll be back in studio. Tons of fun. If you are listening on the YouTube channel or on the podcast, we love it. Leave us a review, by the way. I would love that. Maybe share the podcast with a friend would be really, really cool, right? Like just send it over, take a screenshot, share it on social media. That would really, really help us out. But what I really want you to do is go to nyais.com, be a part of this lively chat, be a part of the community that we have here. Maybe join us on a live event one day, get a nickname. Who knows? Anything could happen. But I really, really want to thank those of you that joined us for this call. It's the middle of your work day. It's a Thursday. The fact that you're spending an hour with us means the world to me. It means the world to GC. And it's really, really what drives this show, man. So really, really appreciative of that. GC, I'll give you kind of last words, my friend.
I love you guys. I appreciate the platform that we have. And the reason we have a platform is because of all of you. You take time out of your day each and every Tuesday and every Thursday to come and hang out and give us this opportunity to speak about what we're passionate about. Amazing to know that you're passionate about it too. So I love our community. I just want to say thank you again. We have got some amazing things coming up. I'm excited about this thing on Tuesday. But before that, we've got Memorial Day in Pittsburgh led by Jen and Renee and the Pittsburgh contingent of the Not Your Average Investor community. So can't wait for that to happen and you know, give a call and check in with you guys and be with you in spirit up there. Tuesday is going to be a great show. And then get excited for this meetup in Jacksonville as well. June 24th. This is going to be, we don't call it the super duper meetup for nothing. All right. This is going to be a big one. And so if you would like to be a part of that, it is June 24th. That's a Friday. You can come in. We've got the entire day planned. You can hang out for the weekend, enjoy Jacksonville, and reach out to Jen Filzen. I'm sure she's given her information already. Reach out, be a part. We would love to have you come and hang out IRL style.
Another word for super duper is not average. Don't be an average investor. Join us in Jacksonville. See you on the next show.